Learning objective 4 basically looks at assigning those costs. So once the job is done, right? Once that work in process is processed, then we're moving it over to finished goods because now the company can actually sell them because they're finished. They're ready to be sold. And so we're going to be looking at the next step, which is assigning those costs out of work in process inventory over to finished goods inventory. Okay. So when a job is complete, you will actually see the completed job cost sheet. Now, this should look pretty familiar and should be a lot more understandable now. So we have job number 101, and that 1,000 of these were created, direct materials of 12, direct labor 15, overhead of 12,000. So total of $39,000 of costs to create 1,000 of whatever this was in this job. So each unit costs $39 for each unit there. So this is what a completed job cost sheet looks like. And this is something that you should be able to read by studying this. Should be no problem. So when it's complete, it is no longer a work in process. It's a finished goods. It's part of finished goods. So we actually have to transfer it out of work in process into the account finished goods inventory. So that's basically what this shows. So here it shows that we are debiting the finished goods inventory for the $39,000 of goods that are done. And we are crediting the work in process inventory because it's no longer work in process, it's done. So we credit the work in process inventory here as well to show these are now finished goods. So also on the 31st of January, they actually sold their job 101. Remember, that job cost them $39,000 to do, but they actually sold it for 50 grand. Woohoo! So how does that look? How does that look? Well, remember in accounting, from accounting 104, you might remember anytime there's a sale from a merchandising company, we got to do two things. We got to record the sale, which is what this is here, right? So we're going to debit our accounts receivable because we sold this on account, right? And we're going to credit our sales revenue. But we also have to do that second entry, which is to record the cost and take it out of inventory. So for a manufacturer, the cost of goods sold would be debited for $39,000. Remember, cost of goods sold is a expense account. And finished goods inventory, which is an asset account, would be credited by $39,000. So our asset account would decrease and that cost would move over to our expense account, cost of goods sold. And that's what it would look like as a journal entry. This is what it would look like in the ledger. So look at this flow, baby, check out the flow. You just witnessed an incredible flow. It's like climate change, but in managerial accounting. Look how it all started. Started with raw materials inventory, started with factory labor, started with manufacturing overhead. That's the start of it all. We had to assign factory, everything had to get debited to show we had it. Then we start assigning things to work in process inventory as jobs get started. So that means raw materials, direct labor, and manufacturing overhead are getting assigned into the work in process inventory because they're starting to make the products. Once the products are finished, right, they are moved over to finished goods inventory. Again, this is another asset account. So they're taken out of the work in process inventory and moved into finished goods. Finished goods are basically available for sale to customers because they're finished. Once they're sold, you'll see it here. You take it out of the finished goods inventory with a credit, and you assign the costs to cost of goods sold, which is an expense account. This is the entire flow, okay? The entire flow is here. Woohoo! So from accumulation to assignment, you saw the whole thing in process here. Congratulations. And don't forget those documents. Remember, accounting is, all areas of accounting really look at documents as a way to justify and prove that they're doing their accounting properly. And in an audit, you need to produce certain documents to show you are doing things properly. So the documents that you saw and learned about, your source documents include the materials requisition slip, those labor time tickets, and the calculation of the predetermined overhead rate. All of those, of course, are shown on that job cost sheet. That, of course, becomes the basis of all the other information that you saw earlier. Okay. But you might know, or may not know, that even though we've been talking about manufacturing, and this course does more emphasize manufacturing than any other industry, job cost ordering can be used and is used in service businesses. Okay. So for example, whether it's healthcare, accounting, or banking, all of these companies are tracking the costs of jobs for specific customers. And that's a very, very important. So they have their own sets of documents and original forms that they are tracking and making sure that they're keeping track of, because they also are in business to make a profit and they have to evaluate the costs very carefully. All right, so here's another little story, but this one's on General Electric, which, of course, this was written based on something in 2009. It's a totally different company now. It's much, much smaller than it was before. But one of the things that GE had been known to do for many, many years, and they might have sold this part of the business off, is that they actually make jet engines, okay, for many of the airplanes that you and I might have been on, okay. And so jet engines are pretty costly, about $30 million an engine. You know, $20 to $30 million per engine. That's a pretty good price for a particular product, right? But you would think that that's good enough because it's $20, $30 million for an engine that they're making profits on it. No, they're really, really not. They don't really make that much profit by selling engines. So how do they make profit? Well, basically, most of their revenue is from servicing the product. So not only are they selling a product that's very high cost, but they are not making that much money on that, but they are making money servicing the engines, okay? So basically speaking, $13 billion in aircraft engines that were sold in a 3-year period generate about 90 billion in service revenue. Auto dealers are the same way. They'd rather you buy a new car from them, and they're not going to be making, you know, they might not make a lot of money on the sale of the car. There's not a lot of profit perhaps for them in the sale of the vehicle, but they're hoping that you come back to them so they can take care of the vehicle, and that's where they make money, on the service revenue. And so this is a very, very important type of thing to understand. Service companies need to know about their costs, and they also need to be very, very profitable. So with any system, there's advantages and disadvantages. And so your book talks a bit about your advantages of the job order costing system. It's certainly as precise as it can be, and it provides an enormous amount of good information. Unfortunately, that means that there's a lot of data entry that needs to be put in. Everything that you do has to be recorded. and that's usually inputting it into computer system. And that's a disadvantage. It'd be easier if it could be scanned or other types of things. That does make it easier, but that data entry sometimes is not that easy. As you saw, the requisition slips and other things, they were signed, and the signatures on the bottom of things, time cards, etc. So oftentimes there's a lot of data entry that's done. And here we are at the end of our objective number 4 here, with the completion and sale of a job here. So we have Onyx Corporation. They just completed job 109 and job 112. Job 109 cost them $19,000. Job 112 cost them $27,000. Job 112 was sold on account. Remember that, on account, for 42 grand. So journalize the entries for the completion of the 2 jobs. That's the first part. And then journalize the entry for the sale of job 112. Okay. So remember, when they complete the jobs, they have to be moved out of work in process into finished goods. So the first thing you know is that these jobs, the $19,000 and the $27,000, are totaled together for the $46,000. Okay, so both of these jobs are moved into finished goods inventory with the debit. They're moved out of work in process inventory with the credit. Okay, so that's the first part. Those jobs are completed and they're moved into finished goods. Now you've actually sold one of those jobs for $42,000. You actually sold job 112, which cost you 27 grand. So first thing is you're going to record the sale. Accounts receivable gets the debit, sales revenue gets the credit because you sold it for 42 grand on account. And now you have to record the costs. The cost is here, 27,000, right? So that's what's showing here. Cost of goods sold of 27,000. Finished goods inventory account is going to be credited by 27,000. And there we have it. Questions?